everyone, and thank you for participating in the 2024 DBE Online Video Training Series. This is the second training video of the series titled Partnering to Win Contracts. In this training, we're going to be discussing different teaming agreements, as well as the accounting and compliance considerations that go along with them. Many of the firms we work with share the same struggle of lacking sufficient equipment or resources to be competitive in government bidding. This could be having to pay more money to rent versus owning equipment, assuming there's even any equipment to rent. It could be managing a freight company with only one truck and struggling to get selected for a contract. Or it could be not having the experience or confidence to bid on a larger project. So this is where teaming agreements can have a major impact on the growth of your business. Partnering together with other firms can elevate the value of your bid by combining the resources and experience of multiple companies. So today, Chris and I are going to be going over some concepts, strategies, and considerations when looking into pursuing if a teaming agreement is the right decision for your company. So these are the learning objectives we're going to be going over today. First one is going to be a joint venture overview. So what is it? Looking at the pros and cons of a JV and the difference between a joint venture and a partnership. Then we're going to be talking about the process of actually forming a joint venture. So looking for the right partner, discussing a little bit about family dynamics, different types of joint ventures, and joint venture agreements or JVAs. And then we're going to be looking at accounting considerations for these joint ventures. So we're going to look at different types of contracts, how we allocate revenue through the different members, and some common accounting issues that are likely to arise. And then finally, we'll look at government compliance. Specifically, we'll take a look at the Small Business Administration or SBA regulations. We'll look at performance of work, limitations on subcontracting, and then some final compliance items and tips for best practices. So with all that, I'll go ahead and turn it over to Chris to get us started here.
Thank you, Jake. So let's begin with defining what a joint venture actually is. According to 13 CFR section 121.103, subparagraph H, a joint venture is an association of individuals and or concerns with interests in any degree or proportion intending to engage in and carry out business ventures for joint profit, for which purpose they combine their efforts, property, money, skill, or knowledge, but not on a continuing or permanent basis for conducting business generally. Who loves reading federal regulations? It's an endurance challenge sometimes. But let's break down what that actually means. So a joint venture involves two or more businesses agreeing to invest and operate a single business together. It is a contractual agreement formed by companies that ends on a specific date when the project is completed. It is usually formed to enhance the value of each party's investment by sharing the risks and rewards of running an organization. The joint venture shares costs, resources, collective past performances, and can leverage other partners' experience and market share. It's important to note that a joint venture relationship is a fiduciary one, in which the members owe each other the highest degree of good faith and fair dealing. Each member of a joint venture acts for themselves both as the principal as well as an agent for the other members within the general scope of an enterprise. So why start a joint venture? The biggest perk is that joint ventures can result in higher confidence for both the contractor and government perspectives. Risks are lowered due to the increase in experience, assets, personnel, and other shared resources. There are lots of different reasons why companies form joint ventures, but it's always for a specific goal or venture rather than a long-term ongoing partnership. And speaking of partnerships, although sometimes used interchangeably, a joint venture and a partnership are two separate forms of collaboration, and it's important to know the difference. The entities involved in a partnership are called partners, whereas entities involved in joint venture are called members. A partnership involves an agreement between two or more parties where they agree to share the profits as well as any loss incurred in a combined business. A joint venture can be described as a contractual agreement between two or more entities that aims to undertake a specific task. Now, some of you might be scratching your head thinking, well, that sounds like the same thing. And that's why these terms are often so often used interchangeably. But the differences are really in the minutiae of how and why the entity is established. As a general rule, a partnership is intended to last for a long time and undertake multiple projects over the course of that time. For example, if you were going to buy, fix up, and sell houses every year, you would be more likely to have a partnership with a contractor or a land developer. A joint venture, on the other hand, is typically related to a single transaction and is shorter and far less complex in nature. A partnership is much broader and can be an ongoing collaboration. For example, Amazon partnered with Kohl's to service Amazon product returns. Over time, Amazon added their delivery platforms into the stores and continue to find innovative ways to capitalize on that partnership. So it's not about a single event in this case. Typically, in a partnership, persons involved are co-owners of a business, and their aim is making a profit. But in a joint venture, it's not necessarily just profit that binds the parties together or drives their motivations. Joint ventures are often formed for specific strategic purposes, which we'll discuss here in a minute. Although a joint venture is very similar to a partnership, a joint venture is generally more limited in scope and duration. Since a joint venture is generally considered to be a partnership for a single transaction, the rights and liabilities of joint venturers are governed by the principles applicable to partnerships. The ultimate advantage of a joint venture compared to other organizational models is the ease of creation and the seeming simplicity of just doing business together. Something worth noting as well is that both partnerships and joint ventures, along with all their members, are in privity of contract with the government. In other words, the contract only concerns the individuals involved in the contract agreement, and only they have enforceable privileges and responsibilities under that contract. This becomes particularly applicable when incorporating subcontracting into joint venture projects. Now, the benefits of a joint venture. So let's talk about that. At the core, joint ventures are a great way to create more opportunities for small businesses. They're also mutually benefiting relationships, not only for the venturers, but for government procurement officers as well. First, government can look to the combined resources of two or more companies to perform the work and consolidate requirements with a single entity. A lot of the time, 1 + 1 might equal 3 from a procurer's perspective when it comes to a qualified joint venture. A joint venture also creates a single point of contact amongst the businesses that would otherwise have separate contracts, and reduces some of the variables of managing the project. It also reduces the administrative burden and can even eliminate some potential risks. Two, from a junior or minority venturer standpoint, there's ample benefits of forming a joint venture. First of all, there is a significant increase in capacity and capability when you team with a larger and more experienced organization. However, despite that organization being bigger and more experienced, there is an influence and control factor for a minority joint venture member. Smaller companies can exert more control over the performance of a contract than in a traditional prime and sub relationship, which helps smaller companies protect their interests over the contract performance, making decisions and gaining experience at an expedited rate. Thirdly, joint ventures allow for bigger businesses to participate in set-aside contracts they would not otherwise be eligible for. For example, a veteran-owned small business or woman-owned small business set-aside project. So there's that strategic element at play here. While a large company may want to bid on the project, they may not meet the requirements to do so, and as such would benefit from joining with a smaller company that does meet those requirements. Be aware that if it is a set-aside project, there are additional requirements that go into structuring a joint venture we'll discuss later. Now, from the smaller company's perspective, it can be difficult as a small business to compete with larger companies when bidding for government contracts. So if two firms join together and bid together, they may have a better chance of winning bids by combining their experience and expertise to win the contract. This is especially true if the contract requires a lot of specialty work that a qualifying firm is able to do. And fourth, joint ventures can also give a lot of control when it comes to revenue streams. In a typical prime and sub relationship, 100% of the revenue is attributed to the prime and then flows to the subs. Whereas in a joint venture, you can split the revenue streams amongst the different venturers and have more control over your company's income and financials, which can be useful to maintain the small business eligibility and accompanying certification. So let's talk about the challenges of a joint venture. Firstly, the lead contractor is required to give up substantial control. Companies with a lot of experience and past performance will have to relinquish some of that control and oversight of the project to your equal member or members. This can be a challenge for some companies and individuals who want things done a certain way. All ventures need to be on the same page with how this arrangement is going to work. Second, improper joint venture structuring can cause concerns from the government's perspective. The government may view the joint venture as lacking a clear point of contact, which can raise concerns regarding control, authority, and accountability. It's important to be transparent and communicative with the structure and presentation of the joint venture. Number three, joint ventures tend to be longer and deeper commitments than traditional teaming agreements. Since the work, profits, expenses, and everyday challenges are being shared between two or more parties, joint venture relationships involve a lot more collaboration and teamwork than a prime and sub relationship. This can actually be very beneficial or an extreme setback, depending on personalities, business characteristics, or working relationships. Number four, it can be complicated to divide the percentage of work among the venturers. This is a big one. Outlining the percentage of work and staffing is critical when forming a joint venture, and if it's not clearly defined from the jump, it can lead to problems down the line, especially if these are large expenses or administrative functions that aren't attributed to any party. Usually companies are so full speed ahead to get the joint venture formed and the JVA signed so they can create the proposal and submit it in time, but there are countless things that can be overlooked and can result in major issues. And lastly, number five, finding a fitting partner can be difficult because a party needs someone who shares their company's vision and wants to grow the business together. The other party might not fully understand the project objectives or become distracted by other pursuits and projects. The venture may fail because one partner is unwilling to invest their time and money. Also, if possible, joint venture partners contribute a certain amount of initial capital, typically with a 50-50 distribution of profits. In some cases, the more experienced party can be the lead partner and can contribute 60 to 70%, which can lead to an imbalance of assets, investments, and the power to make decisions. So now that we have a general understanding of the parameters of a joint venture, as well as the benefits and challenges, let's look at actually forming one. The first step is to know your goals for starting a joint venture. Are you trying to bid on a particular project, diversify experience, or manage revenue streams? It's important you understand what you want out of the joint venture and a partner in order for you to choose the right one. Your partner should understand your goals, align with your organizational mission, and be a good fit to help you achieve them. If you're the junior venturer, you're looking for a partner who can also serve that mentor role. So the decision goes far beyond just searching for a big company with lots of assets and a better likelihood to win the contract. The second step is to research and evaluate potential venture partners. They should be able and willing to invest capital, provide resources, and successfully manage and execute contracts. Assess your potential partner's financial resources and expectations from the joint venture arrangement. Be prepared for negotiations, including sharing customer lists, production schedules, and maybe even proprietary information with trust. Despite joint ventures having an end date, remember this is still a team, and like any other team, it relies on collaboration and synergy of the parties in order to be successful. A good idea is to conduct a competitive SWOT analysis, SWOT, to determine the characteristics of a potential partner. So research their website, social media pages, capability statement, business credit score if applicable, and past performance. You should inquire into their vendor relationships, distribution channels, assets, etc. You want to know who truly it is that you're going into business with. And again, when looking for partners, you want to find others that are similarly minded in their goals and initiatives so the venture remains mutually beneficial throughout its life. Seek out firms with similar or complementary target markets, products, or services. Step 3, think long term despite the nature of a joint venture. When establishing a JV with partner, you should think long term despite the fact that most joint ventures are developed for a specific project and have a finite time frame. This is because even in that short time frame, it's possible to have ownership changes in a partner company, have an owner retire, or maybe even have personal issues that prevent them from continuing on. You want to be sure that the next in line is still someone you can and want to work with. Plan for those what ifs and worst case scenarios. Step 4 here, a common question is, what if you want to add a new partner to an existing joint venture? Since the joint venture is already established, it's easy to add a new party. However, you should ensure that the new entity will fit with the current terms and agreements. All worst case scenarios that you went through before when establishing the joint venture should be heavily scrutinized again with this new firm in the picture. A new member could add unintended consequences. So while you don't need to repeat the entire process, it's always a good idea to make sure everyone is on the same page and review the joint venture agreement again in detail. Step 5, where do you even start when looking for a partner? One of the biggest complaints we hear is that there's no real platform to meet willing partners. Especially with the Small Business Administration's Mentor Protege program, there's not really an outlet for a company to sign up and say, I'm looking for a senior joint venture partner. There are online networking events that the Office of Small Disadvantaged Business Utilization puts on in terms of people meeting and forming joint ventures through that. Most joint ventures are formed organically out of amiable relationships that naturally grow from doing business in the industry with different companies. But there are some opportunities to seek out potential partners. Attending industry association meetings, trade shows, and networking events can be a good way to meet new people. If you're approaching another business about forming a joint venture, regardless of your size and experience, be sure to have a strong value proposition for them, to be interested and willing to work with you. The more prepared and established you can present your offer, the more likely the other party will seriously consider it. Also, a best practice is to bring people along with you on the joint venture journey for continuity and experience. The process is unique and takes a lot of initiative. So if your team can see the success of how this all came to be, that's extremely valuable. This is especially useful when considering succession planning for your company as well. So, family dynamics. Who doesn't love creating even more potential opportunities to argue with our families? But businesses are like families. It's inevitable. Be cautious of going into business with family or friends. You need to be able to detach from the emotional connection to the person and be able to operate as two business professionals. The first thing to consider if a family member is truly the best partner for the venture. Are they qualified? Do they want to join together, or do you want to? Sometimes a family member is great in a manager or executive level position, but does not have the desire or skills to be an owner. Number 2, keep the deal at arm's length. This means being detached from that emotional connection. Sound business decisions are not based on emotion and human connection like our personal relationships are. Business decisions can be ruthless and damaging, but sometimes if that's what's best for the organization as a whole, then those difficult decisions need to be made. Is that something you want to risk having your family or friends involved in? Number 3, the litmus test. While litmus test is technically a scientific test for acidity, it's often used as a slang term for making a judgment about whether someone or something is acceptable. Again, think of those worst case scenarios, and now imagine they're between you and your family or friends. How does this carry over into your personal life? What will Thanksgiving dinner be like if the arrangement doesn't work out? Number 4, to combat some of these concerns, consider bringing in an unbiased third party to help manage the transaction and keep the business from getting personal. Once a partnership is formed, The next thing to do is choose the right business structure. The most common joint venture business structure is a limited liability company, or LLC. There are other options as well, such as an LLP, limited liability partnership, but these can be expensive, complex, and potentially not even possible based on the state and regulations. We'll get into those in the next slide here. The structure of the business is wholly dependent on the needs of the joint ventures and the goals of each venturer. But remember, regardless of the type of structure you choose, they all come with responsibilities such as filing and paying business taxes. The benefits of an LLC. So LLCs have operating agreements that are similar to joint venture agreements, so it's easy to craft both of those simultaneously. Also, unlike a corporation, an LLC doesn't require shareholder agreements and bylaws. Given the limited nature of a joint venture, most people prefer to utilize a structure that's simple and doesn't require massive future and contingency planning, since the main focus is to complete a specific project and not grow a company. Consider the joint venture's home state. You may be partnering across state lines or pursuing contracts in different jurisdictions. Certain certifications like DBE, Disadvantaged Business Enterprise, are state specific. You want to be cautious about potentially nullifying your minority advantage by how you are structuring your joint venture. For example, if you're running a property management or housing development venture, the LLC will need to hold the property in the state the property resides. Now, finally, let's talk about populated versus unpopulated joint ventures. A populated joint venture has actual employees who are employed by that joint venture, not the companies that make it up. Conversely, an unpopulated joint venture is essentially a shell organization with no employees or a very select few that perform administrative functions, depending on regulations. In an unpopulated joint venture, the work is subcontracted to the venture members for the actual contract performance. So we'll go a little deeper into that right now. Referring to the CFR again, Code of Federal Regulations, if a joint venture exists as a formal separate legal entity, it cannot be populated with individuals intended to perform set-aside contracts unless all parties to the joint venture are similarly situated, meaning that all members qualify for the set-aside. In other words, a populated joint venture that is not comprised entirely of similarly situated entities will be ineligible for any contract or agreement which is set aside or reserved for small business. At the core, populated joint ventures risk exemption of the affiliation rules and are treated differently. In almost every scenario, populated joint ventures are far more complex than unpopulated joint ventures. How the revenue is allocated and how the processes work brings a lot of variables, and it can get a little messy. Unpopulated LLCs are the most common type of structure that we see. Specifically speaking on IDIQ contracts or indefinite delivery, indefinite quantity, one of the best practices is to track the individual amount of effort and funding at the task order level, since you won't know the total amount of the IDIQ at the beginning. This isn't a requirement, but by allocating tasks and costs for each individual task order, you can avoid waiting until the end to try to determine all the work percentage allocations across the entirety of the contract's lifespan, and ensure that you're not surpassing individual limitations. So we'll talk a little bit more about the pros and cons of LLCs versus LLPs. Some pros for LLCs. An LLC combines the tax benefits of a sole proprietorship with the personal liability protection of a corporation. Since an LLC is its own legal entity, it can take on business debts, own property, and have a bank account without attaching any liability to its individual members. LLCs are common among small businesses and entrepreneurs because they offer tax benefits and liability protection without the formalities of a big corporation. Cons for the LLC. Some states require a limited lifespan for LLCs. So you want to verify in your state if that stipulation exists, and if so, what is that limit? Also, LLC members are considered self-employed individuals, and self-employed individuals do not have FICA taxes withdrawn from their paychecks. What you see on pay stubs, Social Security and Medicare contributions, things like that. So instead, self-employed people pay FICA taxes directly to the IRS, and that responsibility falls on them. So for the LLP, here's some pros. An LLP is a type of limited partnership that can usually only be created by licensed professionals, such as attorneys, accountants, or architects. Unlike LLCs, an LLP will allow some limited partners to be passive owners with lower liability and no management responsibility. LLPs are common amongst licensed professionals because they offer protection against liability arising from negligent business partners as well as business debts. They also share flexible management pass-through taxation like an LLC. For those unfamiliar, pass-through taxation is a tax treatment that allows all income, losses, credits, and deductions of a business to pass through to the owner or owners. In other words, when the business makes a profit, the entity itself doesn't pay tax on its income. Instead, the income passes to the owners of the business, who pays personal income taxes for their share of the business. This eliminates paying taxes twice, once at the business level and again at the personal income level. So what are some cons of the LLP structure? Profits from LLPs are taxed in your personal name under income tax through pass-through taxation. The difference with an LLP, however, is that this is mandatory and not flexible like an LLC. So it could be pro or a con depending on the situation. But the benefits of an LLP don't lie in the tax treatment. It lies in the liability structuring that protects the partners. Like I said, some agencies or programs restrict LLPs to specific specialties. And there are other considerations that will depend on your state laws as well. For example, it may be more expensive to run an LLC than an LLP in your state. Additionally, some states won't allow professionals to form an LLC, in which case an LLP is the far superior option than any other kind of partnership, since it offers at least some liability protection for your partner's potential negligence. Regardless of your profession or goals, you'll want to do the research for your jurisdiction on what options are available to you. You can also seek out business development resource partners, such as Apex Accelerators or Small Business Development Centers in your state, to help point you in the right direction and answer some of these questions. So let's talk about the joint venture agreement itself. A JVA, as it's commonly referred to, is a legal document where two or more entities combine to do business or undertake an economic activity together. The partners agree to create a new entity for a finite time by contributing equity and share the revenues, expenses, and control of the enterprise in the proportion of their capital contribution. So, in crafting this, be specific about profits, expenses, work share percentages, and dissolution processes. When you create a joint venture, you really want to identify how the relationship is going to work. A lot of companies use very generic JV agreement templates that are bare-boned because, like I said, they're more focused on trying to put together a proposal and win a specific contract. It's worth the time and investment to ensure you negotiated all the terms you think are important and talk through issues and expectations you may not think about at the front of a new partnership. Creating a joint venture agreement draft is important because this will dictate the partnership's direction. It's best to hire an attorney for assistance if both parties have no experience in the drafting process. In fact, you should always confer with legal counsel when crafting a JVA. It may also be beneficial to preemptively speak with an accounting professional to ensure tax and financial management is addressed and proper contingency protocols are implemented. Whether you use a template or seek legal counsel, there are some absolute essentials that should be incorporated into the joint venture agreement. The type of joint venture, the purpose of the joint venture, both contributions of the parties, whether equal or unequal, profit and loss allocations of the parties, each party's voting rights, meeting schedules, end date or termination clauses. These clauses generally include if there's an agreement between the members to terminate the joint venture, if it's apparent that a joint venture is not profitable and activities are abandoned, or on death or withdrawal of a joint venture member if a replacement joint venture was not obtained before the death or withdrawal. Best practice when crafting a JVA is outlining every single what could go wrong scenario and plotting out solutions to those issues. So remember, number one, Outline the profit, expenses, and work share percentages clearly. The more effort you put in up front, the less likely you are to have issues down the line. Number 2, establish contingency plans and discuss worst-case scenarios. Hopefully they won't happen, but if there's one thing we can count on in our industry, it's that there's going to be unknown variables at play that could affect how we conduct business and work with our partners. Number 3, plan for the succession or dissolution of the joint venture. Specifically, what are the rights of the members who want to exit a joint venture? Personnel changes can completely alter the health and relationship of a joint venture. And number 4, always seek counsel from legal and accounting professionals. Be sure to find counsel that is experienced in your field, because often they will be able to provide insight and prevent mishaps that generalized attorneys or accountants wouldn't have much experience in. And with that, I will pass it back to Jake.
Thanks, Chris. So now let's switch gears and talk about accounting. So when it comes to accounting, you just need to be equipped with the essential accounting information to make effective management decisions. You don't have to know all the inner workings of the accounting processes, and this is where you would typically seek counsel or hire professionals internally. And again, I'll reiterate that unpopulated JVs are also substantially easier to deal with from an accounting perspective than a populated JV. With populated JVs, figuring out what your costs are and whose direct rate are going to be going up and down, all of that can be problematic. So let's start by talking about a few different contract types. First one we'll look at is a firm fixed price. With this type of contract, there's a higher importance on the contractor to estimate the statement of work accurately up front, because there's more risk on the contractor. The government only owes you the fixed price regardless of whatever unknown variables pop up that have a tendency to appear during projects. So a good practice is to start with is to split the JV statement of work into 2 separate statement of works, as if each partner is actually a sub to the JV prime, which is essentially how the work is flown. So if possible, monitor the costs incurred as if it were a cost type job. It's not required, but if things do go sideways, you'll want to know the individual costs incurred during the project and which party is responsible to either execute a task or even pay an expense. So now we'll look at T&M, or time and materials and cost type. These types of contracts place a higher importance on job costing and accurately reporting costs. There's an increased risk for the government on these types of contracts because they are paying the cost as the project evolves. So having meticulous job costing data and tracking the responsible parties is imperative because there's a lot more oversight in reporting to the contract owner. Now let's take a quick look at financial statements. This is a commonly overlooked process when it comes to forming a JV. Who is actually going to be responsible for generating the financial statements? The operating agreement should dictate who's responsible for the JV's financials, and it's usually going to be the managing member. Oftentimes in a set-aside contract, the government will actually require that the firm that's eligible for the set-aside be the one who prepares and submits all the required documentation. It's also important to discuss preparing quarterly financial statements. Members will usually want or need quarterly financial statements for estimating quarterly tax requirements, so determining who's preparing those and what that process looked like is going to streamline those estimates. Some of the most common financial statements needed include a P&L, or profit and loss, a balance sheet, statement of cash flows, any changes in partners' equity. And again, it's coming down to determining who is going to be responsible for this. So next, we're going to talk about allocating revenue. We talked earlier about revenue streams, and as a reminder with JVs, revenue is recognized within the joint venture itself, which gives the parties more control of how that filters into their respective companies, and by extension, how that affects their business size, profitability, and tax alterations. So allocating revenue for SBA size determination purposes are split between ventures commensurate with work performed and ownership. So the SBA makes small business size determinations based on different metrics, and which metric they use is dependent on your NAICS code. Some NAICS codes determine small business status by annual gross revenue, usually averaged over 3 to 5 years, while other NAICS codes use the total number of employees to determine if a business is considered small. So again, know the specifics of what your company's determinations are and how allocating revenue could affect that. Next, let's talk about defining revenue shares up front within the bid. And again, we're going to be specific about how we define those revenue shares. And there's a reason I keep bringing up specificity. Joint ventures need to identify how revenue shares will be distributed. And things to remember and to consider for each member are scope of work, required hours, subcontractors. Is either member planning to sub the work out? Because there should be additional revenue flowing to that member so that they can pay their subs. And of course, there are additional rules on this as well that we'll go over. And then incurred expenses. Who's paying the bill and with what money? Another important consideration is the indirect cost rate structure. So again, with a populated GV, you're going to ask yourself, what G&A am I using? Or do I have to use multiple different overhead rates? How do we determine an overhead rate for this entity? Whereas with an unpopulated JV, a lot of those questions don't matter anymore because you're sending your individual company costs, burden rates, overhead rates into the JV to determine the JV indirect cost rate. So to clarify, each individual member builds the JV with their own established rate structure and uses that structure to burden their costs. Some companies, it may be a good idea to consider putting caps on indirect rates up front to alleviate any headaches in case one of the members has some volatility in their rates or changes rates during the period of the contract. And finally, you should never take 100% of incoming revenue from the JV into one member, especially on set-aside contracts, because this invalidates the percentage of work complete if there is no revenue flow to one of the members, especially if that member is the qualifying entity for the set-aside. So some common accounting issues to look out for. First one, the logistics of operating two separate bank accounts can lead to issues. With separate accounts, there may be disagreements over who should pay for what expenses or how much each partner should contribute. By pooling funds into one account, these discussions become more streamlined and less stressful as both parties have equal access to funds and can make decisions together. Note that shared accounts may require signatures from both parties to withdraw. So the more outlined this process is from the beginning, the less likely there is to be an unauthorized draw from a shared account. Another issue is executing negotiated work shares. So determine direct and indirect responsibilities up front with the costs and accounting considerations associated with those responsibilities. Be very specific with which member is responsible for staffing which task, almost down to the labor category level if you can. An example of this is to say, back office functions will be executed by the mentor until the junior member has the means to do it themselves. And there should be an annual progression, benchmarks, and timelines to see that process through. And ultimately, you're setting up the junior member by phasing them through the process and slowly transitioning those programs over to them. Lack of contingency plan. We've mentioned the importance several times of defining the potential worst case scenario situations up front. So try to plan for the unexpected so you don't have to make these hard choices and decisions during a stressful or heated situation. Instead, you'll just have to refer back to what the JVA, the joint venture agreement, states to do in that moment. And finally, don't forget about the Federal Acquisition Regulation, or FAR, to ensure you remain in compliance with the accounting processes. So things like what are allowable costs and who is responsible for paying what. Different types of costs such as organizational costs, setup costs, rental costs, facilities. It can go in a million different directions depending on the JV size, the contract, the state, and any other regulatory requirements. And again, this is where having an experienced professional will help. And bear in mind, an accounting professional may not be the same person who does your books or your accounting. It may be a specialized firm. So if talking about accounting considerations didn't get your blood pumping, I'm sure talking about government compliance would. The SBA outlines compliance items for forming joint ventures as well as 13 CFR 125.8, which is literally titled, "What requirements must a joint venture satisfy to submit an offer for a procurement or sale set aside or reserved for small business?" So the first bullet here states that the joint venture must be separately identified with its own UEI, or unique entity identifier, and commercial and government entry, CAGE code, in SAM.gov. Additionally, in SAM.gov, you'll designate the entry as a JV, as a joint venture, with the individual members listed as the immediate owners. Then you're going to get approval before submitting an offer for a small business contract as a joint venture. Don't rush past the proper forming process, but the JV must be established and approved before submitting a proposal. It's also worth noting that the government must take into consideration past performance of all the JV members on set-aside contracts. Historically, many agencies wanted the JV itself to have past performance and not the individual members, but that's not the case any longer. Joint ventures are qualified for 2 years, starting from the date of the first awarded contract. A couple of notes here are that 1, novations or substituted contracts in place of old ones are considered awards. And 2, there's no limitation on the number of contracts that can be awarded to a JV during the 2-year period. It used to be a limit of 3 contracts in a 2-year period, referred to the 3 and 2 rule, but that was taken away in 2021. The SBA no longer approves JVAs formed to pursue competitive 8A contracts, but still does review and approve all JVAs formed to pursue sole source 8A contracts. And to clarify, a sole source contract is a kind of contract that can be issued without a competitive bidding process. And the last bullet here, joint ventures have the potential to become affiliated, which is important because that could nullify a small business status and make a JV ineligible for a set-aside contract. So when a JV submits an offer after 2 years from the date of the first award, the SBA will find that joint venture, all the members of that joint venture, to be affiliated, and thus will aggregate their receipts and/or employees, determining the size of the joint venture for all small business programs. So after you reach that 2-year point, essentially the members actually become an affiliated JV. Alternatively, the same JV members may create additional joint ventures at the end of their 2-year cycle, and then each new joint venture may submit offers for an additional 2-year periods without the members being deemed affiliates. At some point, however, such a long-standing interrelationship or contractual dependence between the same JV members in several different JVs may lead to a finding of general affiliation between the two, so ultimately it's at the discretion of the SBA. Performance of work. The qualifying member must perform at least 40% of the work done by the joint venture. For purposes of determining the qualifying member's size, 40% of the revenues under the contract must be appropriated to the qualifying member, regardless of the proportionate ownership percentage compared to partnering members. Clear as mud. Great. So the SBA rules require that the qualifying small business perform at least 40% of the JV's work. Then profits are split according to work share and not ownership percentage. This means that if a small business owns 51% of a joint venture, but performs 40% of the joint venture's work, that small business receives 40% of the profits, not 51%. So what if your NAICS determination is based on number of employees and not gross revenue? In determining the number of employees, the business must include its proportionate share of individuals employed by the JV. So for calculation purposes, the appropriate proportionate share will be the same percentage of revenue or employees as the member's percentage share of the work performed by the JV. So for a populated joint venture, where work is performed by the joint venture entity itself and not by the individual joint venture members, the appropriate share is the same as the ownership percentage share in the JV, which is another reason why populated JVs bring a lot more complexity. Finally, a JV must submit additional documentation to the SBA, including annual evaluation reports that are due 30 days from the anniversary date on the welcome letter, annual performance of work statements, which are due 45 days after each operating year, and project end performance of work, which is due 90 days after the completion of the contract. And there are limitations on how much a JV can subcontract the workload out, which makes sense since the government is really awarding the contract to a specific eligible company. They want that company and its JV partner to do the vast majority of the work to maintain the integrity of the program. So here are the specifics on those limitations. Keeping in mind that non-similarly situated means a firm that is not eligible to participate in a specific contract type alone. So the first one here, pay no more than 50% of the amount paid by the government to non-similarly situated firms for service contracts. It's also going to be the same for supplies or product contracts. Can pay no more than 50% of the work to get subcontracted out. So for construction contracts, pay no more than 85% of the amount, which basically means 85% of the government dollars can go to the non-qualifying firm and its subcontractors. And then lastly, for special trade contracts, pay no more than 75% of the amount towards non-similarly situated firms. So in reality, these percentages are pretty generous and shows that the government wants to afford small businesses the opportunity to bid, be awarded, and even subcontract out on these contracts, while still being able to capitalize on the resources of other companies at a fairly high volume. And here's just some final compliance items worth mentioning. The first one is all elements of the applicable JV regulation must be included in the JVA or the joint venture agreement to be compliant. And that again is coming out of 13 CFR 125.8. I mentioned this already, but the JVA must be finalized and signed prior to submitting a proposal. You don't want to rush that process because that's where it can lead to issues down the line in the project, but it does need to be complete before you can submit a proposal. You want to address any and all negative control questions. The SBA's Office of Hearings and Appeals consistently rule that the qualifying member must have control over if and when the JV submits the proposal, among several other issues. So make sure you check any possible negative control questions because these are red flags from the government's perspective. And lastly, if you do not meet every requirement, you may lose the contract if protested. So pay special attention to what the requirements are, both the long-standing requirements in the CFR and the specific provisions of the contract itself. You don't want to put all this effort into forming a JV, drafting the JVA, and submitting a proposal all for nothing. So to wrap things up, these are a few final tips or best practices moving forward with a joint venture. Always be mindful of seeking professional help because certain requirements may not always be clear. Rely on those mentors, business development agencies, obviously legal and accounting counsel, and don't be afraid to ask a lot of questions. The managing JV member always has to be the qualifying firm. If you are the qualifying firm, be ready to front up most of the work and be the direct POC for the contract owner. Limit unanimous consent requirements to extraordinary actions. Sometimes JVAs are structured in a way that all members have to unanimously consent to execute a task. Needless to say, this can drastically slow down work performance, so we recommend limiting these clauses to extraordinary actions. And finally, the project manager identified for the set-aside contract is usually and should be a separate role from the management board of the joint venture. These are two different positions that require different experiences and skill sets. So just be sure to consider that when structuring the executive leadership of the JV. So in summary, we talked about joint venture, a general overview, what it is, what are the differences between partners and members, and some of the terminology associated with JVs. We looked at why a company would form a JV, sometimes for that strategic purpose of getting set-aside work. And we looked at the benefits and challenges associated with the JV and how to capitalize on the benefits and even overcome the challenges. Then we looked at forming a joint venture. So we talked about finding the right partner that aligns with your goals and is willing and able to contribute to the JV and provide mentorship. We looked at family dynamics and the potential perils that are involved in that process. We looked at different types of JVs, specifically LLPs and the more common LLCs. We discussed the difference between populated and unpopulated JVs. And we looked at joint venture agreements, or JVAs, and how those should be almost painstakingly specific in nature when it comes to work share and cost allocations. Then we talked about accounting considerations, different types of contracts, where the risk lies, and how to accurately account for job costing metrics, specifically on T&M or cost type projects. We looked at allocating revenue and the ways that revenue flows through the members. We also talked about determining indirect cost rates and integrating those directly into the JV. And then we finished up by looking at some common accounting issues, such as operating out of two separate bank accounts, lacking contingency plans, and even being unfamiliar with the Federal Acquisition Regulation, or FAR. And to finalize the presentation today, we looked at government compliance. So specifically, we looked at SBA regulations and small business size determination metrics. We talked about performance of work and how that is appropriated through the members through either receipts or employee size. We looked at limitations on subcontracting, which we saw were fairly high, 50% for service or supplies, 85% for construction, and 75% for specialty trade contracts. And then finally, we went through a few final compliance items and tips for best practices, with the most poignant point being to put in the preparation up front to ensure the success of the joint venture. So thank you all for taking the time out of your busy lives today to participate in this program and listen to this presentation. We hope you're able to take something away from this and maybe even incorporate it into your business in the future. This slide here has our contact information in case you'd like to reach out to us. And be sure to check in next month for our next training video, RFP Prep, How to Crack the Code, which is all about crafting a competitive proposal that stands out from the competition. Again, if you have any questions, please don't hesitate to reach out. And thanks again for participating in today's training.